You're listening to So You Know, a finance and property podcast by UNO, Australia's online mortgage broker, where we deep dive into a single aspect of home loans so you're better informed and can make better decisions when it comes to your property and your home loan. Please remember, nothing in this show should be considered financial or home loan advice. If you want advice relating to your personal situation, email us at hello@uno.com.au or contact your UNO broker.
Welcome to the room, the green room. This is actually a bit green.
Yeah, no.
So, just maybe, Jesse, start by introducing yourself firstly. Who are you?
Yeah. So my name is Jesse. Been in the mortgage and finance space for 8 or so years now.
Right.
But before that, I dabbled in different things. I was in the army when I was younger, coming out of school. Outside of that, my army life, met my now wife. And I've done a bit of work in the dental space as well.
Right, okay.
I'll never...
Being a dentist or just helping in the background?
No, just helping on the business side of things.
Okay.
So, no, don't get me to check your mouth or anything like that. But, just supporting my wife, especially through the COVID years.
Yep.
Like small businesses were just, hit hard. Yeah, so, you just pull your sleeves up and do whatever you can. But, it's been an enjoyable ride so far.
Yeah.
It's just, what I do now, I love what I do.
Yeah.
But, I've had a few different perspectives.
Sure.
A few different, career moves and things like that. So just give me probably a different outlook on.
Yeah. And we're going to dive into that today. So you're a principal broker here at UNO.
Yeah.
Based in Sydney, New South Wales, obviously helping clients all over.
Yeah.
Fully remote. And a bit about what we're going to talk about today. And actually, just before you joined, we went out for lunch and had a good chat about this. So this is a subject that's pretty near and dear to me as well. And I think when you wrote down some notes, I really love this headline that you gave, which is resetting your relationship with debt. I think was that the term you used?
No, correct.
Just let's unpack that idea a little bit first, and then we're going to get into some of the details.
Yeah, look, I think it's just, firstly, it's hard to be vulnerable sometimes,
right?
And understand where there may be a problem, because I think I like to look further than just the numbers in the mortgage. It's like, okay, what's your direction? Where you going? Like, how's the family?
Yeah.
How are you managing things at home?
Right.
What's your stress levels like? What's your
right?
You're looking at
with the mortgage, or even more broad.
Just the impact that not being on top of it,
right,
and not understanding where the issues arise can just lead to so many, negative impacts on your life, whether it's physical and mental health.
Yeah,
relationships massively.
Yeah,
even if you just look at from the wealth perspective for a moment, even just trying to, take that next step, free up, cash flow to, get another property or invest more in your super, like whatever it is. Like, I think it's just, in essence, let's, sit down. If you don't have a good relationship with debt or, with your mortgage,
right,
it's time to reset it.
So it's just such an interesting idea, this idea that it is a relationship. I mean, I guess people don't think about it in those terms, but in some respects, you're in bed with this thing, debt, but specifically mortgage debt for 30 years, maybe less, maybe more, depending on kind of what you want to do.
Yeah.
So maybe you should think about it that way. And so is the question a bit of, are you thinking about it in the right way? Is it a healthy relationship? Is it aligned to objectives and goals and needs? And obviously that's a bit of a moving feast. I fully understand why that term's called that term, but a bit of a moving feast. So let's kind of start from the beginning. You've got a client who's on kind of the arc of a typical journey, right? They start out not having property, and property is part of their overall desire, whether emotionally and part of, bringing up a family and also financially. And then they might move into other stages of leveraging mortgage debt. And I don't want to preempt those. So why don't we just start right with a first home buyer and maybe their relationship with debt and how they might want to be thinking about it even before they have the debt, and then we'll go from there.
No. And this is where it's really good, and what I feel, really passionate about in terms of helping people at the start of their journey.
Right.
So that way they can just, avoid, any crucial mistakes. Sometimes I think it's hard to be patient and look at the long-term vision.
Right.
And sometimes too, you think about like you've gone through school, you're studying, you're trying to make moves in your career. All of a sudden, the whole home buying experience, dealing with banks, etc. It's all quite new to you.
Sure.
So just understanding debt and the compounding effect of interest has, if you don't sit down, look at it properly, it can, have quite a significant impact on your long-term objectives.
Right.
So what I mean, and this is what I tell a lot of young people who are just, like, pick my brain,
Right.
use me as a resource. I'm here to have an open conversation with you. But I wanted
It's
to
a safe space. Phone of silence. We can talk about whatever you want.
Yeah, exactly. But what I typically say is, you're doing great first and foremost, to get into the property market. It's not easy.
Yeah.
Absolutely not easy, especially for someone in, say, their 20s as an example.
Sure.
But you want to have a plan, whether it's, you got your set repayments, you got everything set up once you get approved for a mortgage. But you want to have a plan like, okay, what can I do with my disposable income?
Right.
What is my disposable income?
Right.
So I really understand my budget.
Right.
So then it comes to like, how much money do I want to have, in my safety nest?
Right.
Which, your safety nest can be your offset account.
Okay.
As an example.
Right.
You can use that and be like, all right, I'm happy with that. What else am I using my money for? And I typically say, look, you don't have to just jump and keep doing something else. You've got your own goals, you've got your own, plan and things like that. Yeah. Don't just get influenced by whatever you see online, because there's a lot of mixed narratives out there that are just creative sales strategies designed to
you're just taking action.
Yeah, suck you in and do something you may not have really thought through.
Right.
But in essence, just use that disposable income, pay down your debt.
Yeah.
You can make additional payments into your mortgage. Before you know it, you can look back in like 3-5 years and you can be like, wow, I'm way ahead
right.
of where I'm meant to be. I've got, a huge, redraw.
Yeah.
That's available.
Or a safety net. I think
safety net and
emergency savings or whatever.
Yeah, my offset account. So I've got options.
You're right.
And now it's like, okay, if I want to have those conversations, so I've thought through what my next, investment plan is. I've been like, all right, when I retire, I want to start making some more moves and things like that. You've got the equity. Right. You've got cash in your offset. You've got, you're in a real position to make those moves. And at the same time, you're not, you've done everything you can that you can control to get ahead of your debt and just, not put yourself in a situation where you're under constant stress with your mortgage, because, it can have so many impacts on, your overall life. Yeah. And let's come into that in a sec. I want to just come back to this idea of playing the long game. And you didn't use those words exactly, but, I remember I used to work for accountants, right? Yeah. And I remember I must have been 18, and one of them was like, "You never sell." I'm like, "What?" Because they said and the point they were making, not that you don't sell property, of course, buy and sell if you need to, and if it makes sense. The point that they were making was that it's such a long game, right? And so in a long game, you make large strategic moves with good downside protection, and you hold your position because the benefits come over a longer period of time. And I think the point that you're making about, the noise that exists online is always trying to get you to do something and do the next thing and do it too much. And this may work financially, it may not. The reality of property in Australia, especially, huge switching costs, right? Yeah. High upfront cost to get in, high upfront cost to get out. So moving in and out of property is clearly problematic. And high degrees of leverage come with high degrees of variable risk. And the worst thing you can ever be is a forced seller in any market, not just in property. Oh, yeah. And so moving quickly and moving haphazardly can not only be financially counterproductive, it can also have other knock-on effects, and probably, not for most people, if anyone. All right, cool. So that's a really interesting way to sort of break that down. So let's come back to that first-time buyer. In practical terms, if someone's
early on in their journey, right? They haven't bought that first place and they're coming to you. Like, when are they typically coming to you? It's like, hey, we want to get pre-approved, or we've got $20,000 and we're thinking of buying a place. Are we ready? Like, what's our next move? What should we be thinking about? Like, when are they starting to talk to you, and what's that conversation look like?
Yeah, look, it's funny too. Sometimes people almost feel guilty that they, if they inquire, book a meeting, whatever the case is,
Right.
they almost feel guilty because they're like, oh, I'm not gonna
buy now.
Buy now. I think maybe it's just what the market is out there.
Sure.
People are just put under pressure to be decisive now. Whereas I'm like, guys, relax. Don't have to have all this stuff prepared right now, but let's just open up, have a chat. What's your plans?
Yeah.
What do you want to do? For me, it's not just about the numbers. Where do you want to live?
Yeah. Right. And why?
Exactly. Why? What do you guys do for work? Like, how does everything interact? If you've got kids in school, like, what's your situation with your kids? Are you want to stay in this area? You want to move? So it's a really personal plan.
Right.
That's the way I put it. And I do say to people, like, I'm talking to people now that they might not buy for it. They might not settle for 12 months.
Right.
Like that, by the time they reach, a certain goal of savings or, another something else in their life, step in, buy a property, settle in their first home. It can take a while, and that's okay.
Yeah. Right.
Like,
that's normal.
Yeah. Who am I to tell you that you've got to do it now? Like, I'm here to have a chat with you, open the floor. Hopefully you can come out of it with a clear idea.
Yeah.
And a clear timeline of, okay, this is when we can pull the trigger.
Yeah.
Start buying. You can start to establish like a plan of action.
Right.
That makes it a little bit more real for.
Yeah, and it sounds as well.
Yeah.
Like, and just taking out the influencer type thing, but there is a school of urgency that seems to pervade Australia, which is like, we've got to do this now, and if you don't do this now, you're going to miss out.
Yeah.
And if you had a client who came in or prospective, someone who's not a client yet, they haven't settled a loan, but they're thinking about buying, and they're trading off having to move now, put themselves under financial stress versus be a bit more thoughtful, take a bit longer, but when you do buy really well, then like, this is tactically and strategically a much better way to think about this than buy at all costs now, put yourself under a mountain of debt that you're not ready to service and haven't even got emotionally ready for, that might not even work for you 2 years from now anyway.
I know, exactly right. It's that the mentality of the fear of missing out really comes into play, and where people think, I've got to just take action now. But the worst thing you can do is take action. Then it's like, all right, I'm under stress. I'm struggling to make my repayments. I haven't understood my budget properly.
Yeah.
I don't really have the disposable income to really get ahead on my debt either.
Right. Okay.
There's a lot of different factors at play, and then you've got to look at the other side of it. If there was a like a one-off life event, if I was forced to sell, if something happened, someone was injured, my family, whatever the situation is, laid off from work, whatever it is, right? If I have to force to sell, like, where am I going to be left?
Right. Financially, actual living, all the things.
Yeah, so it's always the glamorous side of, buying property is always presented really well in the mainstream. It's sold to people, but no one ever hears the bad stories either.
Oh, they probably would sell, but they wouldn't help sell more property. So not to be a negative Nancy on it. I mean, I remember reading some stats that basically indicate that of the people who own property in Australia, it's about 92% who own one property.
Yeah.
And then there's about 8 who own 2. 7, it's like it's basically almost 100% on 1 or 2.
Yeah.
And then it's a few percent that own 3 or more. And so what we continuously see is, and probably aspirationally incorrect, is people wanting to go out and build large, property portfolios, massively over leveraged, huge amounts of stress, huge amounts of risk. And there are some winners in that, but it's a confirmation bias that says you're going to hear about the winners. And most people, that's probably not the right journey for. Right.
No, exactly right.
Yeah.
You know, you need the market to work in your favour. I mean, you know, property's obviously worked well for a lot of people
Sure.
that have held it over a long course of time, but you know, again, there's still cases where it doesn't work for everyone.
Yeah.
Yeah, and typically, I guess my outlook on it is to if you and just simplify it. Like, it sounds really good, you know, going out to brunch and being able to tell someone, oh, six properties, whatever, you know, like, you know, that sort of thing. But at the end of the day, you know, if you just look at your net, equity position, that's something you can control. In
Yeah.
the course of time, you can put a real plan in place.
Yeah.
You know, and for myself, for instance, right, you know, you know, in my early 30s now, you know, by the time, you know, I'm in my 40s, I'd like to have my, you know, home paid off in full. Then, you know, I really got the freedom to invest more aggressively.
Yeah.
On the back end of my life, like being like, okay, I'm going from my 40s now through to planning for 65 and 70. Like,
Yeah.
what can I do now?
Yeah.
I don't have this mortgage on my home anymore.
Yeah.
My kids have got stability.
Right.
You know, we've got all this equity. We can, afford to move money, put them into, schooling, private school. As an example, just as an, high level example, there's so many different things you can do that meet your, overall lifestyle goals.
Yeah.
And ways you can really build wealth over the long term and also, decrease your, your expenses that are going out the door.
Yeah. Debt positions.
Yeah. So you can't control what, your property's going to sell for.
Right.
In X amount of years. Like it's the market's going to move.
Yeah.
How it moves. But what you can control is, how you look at your debt,
Right.
the relationship you have with it, and just putting some mitigating factors into play to, get on top of it and get ahead.
And give me some examples of some of those factors that you might have applied for yourself or that you might typically recommend to someone who's got a place, they live in it, and one of their objectives is to build up some equity in it. Like, give me some examples of something.
Yeah. So, if someone, they don't really have any plans to do anything else, they want to save money on interest.
Yeah, be debt free.
Debt free. They want to make some moves to get ahead. I said, have a look at your budget, see how much money you can put in and make some additional repayments to the principal of your mortgage per month. It may not seem like much, but over 3-5 years, that can really lower the interest payable. And if you do some further modelling things, you can see how much further you're ahead on your mortgage.
Yeah.
You'll have like your the limit of your loan, and then you'll have like where your balance is at, and you can see how far ahead you're at.
Right.
And then in 3 to 5 years' time, your property's value is going from here to here. So all of a sudden, you've just got all this
headroom.
Yeah. And you can, you've got a lot more flexibility. You've lowered your debt as well. So when you find the right opportunity, if you were to add, say, an investment property to your portfolio,
sure.
So, all right, now I've got this equity at play. I'm not stressed either.
Yeah.
I feel good. I'm ahead.
Yeah.
I've got options.
Yeah.
Whichever way I go.
Yeah.
Even if you're not going to buy an investment property, you could just be looking to upgrade your home.
Right.
And quite often, the first home you buy is not going to be the one you want to live in as your forever home.
I'll come back to that too, by the way. Keep going.
Yeah. So if you want to upgrade, you do need equity.
Sure.
Especially with the tricky intricacies of buying and selling in the same market.
Yeah.
Quite often, like it's an emotional investment.
Right.
When you look into upgrade.
Right. Is it easier to become your forever home?
Yeah. In a lot of circumstances, it can be.
Yeah. Right.
And you may need to it may be quite tricky at that stage when you're buying and selling. You can't always do it simultaneously.
Right.
So if you've got equity and cash on your side, you can,
you navigate.
You can navigate it, yeah.
Interesting.
Navigate it and make it work.
Yeah. And just in terms, like you talked about repayment as one of the strategies of things that you be thinking about if you're in that position. One of the other ones that we haven't talked about yet, but coming into place, like where does tax factor into that? Like how do you, when you have, you're obviously not providing tax advice.
Yeah.
None of this is tax advice, but when you're talking to someone who's in a position now where they have their own property that they live in, like how do you integrate tax into that conversation, into that thinking?
I mean, I think you just start the conversation with someone, have a look at, are they employed? Are they self-employed? What's their relationship like, with their accountant as well? Is their accountant really hands-on?
Yeah.
Giving them strategic advice, or they just,
filling out a return.
Yeah.
And I'm assuming that the guidance here is find and work with an accountant who is more strategic in working out how to, adjust your situation, or at least lean into the situation.
Exactly.
Right.
So that's where you can, accountants can give you advice, and if you were to say buy an investment property, have a look at the negative gearing, effects, and see how much you can save from just a tax purpose. As an example, accountants can even have a look at some things. If you've got, let's say for example, you're on you're in your 40s and you're looking to plan ahead for the next 20 years into retirement, and you're thinking more about your super. You may have engaged like a financial advisor at that point, and you can do different things with your super in order to reduce your taxable income as well.
Right.
So there's different. There's in essence, I'd say is I think find the people that you trust, and they're the people you can sit down and have a conversation with about your financial goals, your lifestyle goals, and they're not trying to hit you up and go, all right, you got to make a decision.
You got to buy a thing. Okay.
Well, you got to pay me for more information right now. You can actually have a conversation, come out of it, feel a bit more relaxed, be like, all right, it's a bit of a plan here.
Interesting.
Yeah.
And just sorry on that point. So, you're going to have this 30, 20, 40, whatever year relationship with it as a centerpiece of buying and living in a home. For most people, that's kind of not job number one, but a job to be done, and a pretty central one. The equity that you build through having, being good at managing your budget and then utilising the funds to give yourself some headroom, plus hopefully some growth as well, gives you options. And so the second kind of bucket of things is what do you do with that option? Do you just keep going? Some people are like, I'm happy. I don't need to upgrade. I don't need to buy an investment place. As long as I, keep going, I keep going. But it then comes into, well, are you best leveraging kind of the advantages of maybe, salary sacrificing and putting more into super rather than paying down the debt, because you can save tax now and then also generate a return that is at or even higher than the interest rate you're paying. So you're better off purely from a fiscal perspective doing it. And so I guess the point I'm asking is that if you were going to have a team around you, mortgage broker, good tax accountant, wealth advisor at a certain point, is that kind of the three, or and what am I missing?
It doesn't have to be that specifically, but I think you just need trust. You do definitely trust the people in your corner.
Yeah.
I mean, look, a mortgage broker is easy because, me, for instance, pick up the phone, it doesn't cost you anything.
Yeah.
You're not really losing out.
Sure. No risk play.
Yeah. Not
unless it's bad, with us, but if it's assuming there's someone in your pockets you like working with who's helping to solve the bigger picture. Okay, so mortgage broker again.
Yeah, exactly right. And an accountant's an easy one too, because you're gonna, again, if you're running a business, you're quite often going to use an accountant, or if you've got more than just a straightforward tax return,
right?
Typically, you will engage an accountant in most circumstances, because they can add real value, and get you out of any trouble as well.
Avoid the trouble in the first place.
Yeah, that's it. That's true. But in essence, I would say have those trusted people in your corner. They don't have to be, but they're almost like a mentor too. They can just point you in the right direction so you can make informed decisions.
Yeah.
And I think going back to your relationship with debt, if you've got trusted people in your corner, you can make some informed decisions early on in your journey.
Yep.
Or you've hit a roadblock, you're in a bit of, deep water, can make some changes, restructure a few things, get back on track. When you're playing the long game with your relationship with debt, you can eventually be well ahead, like we're saying, well ahead on your mortgage as an example. Then you've got options.
Yeah.
So you don't have to just buy a property just because someone says so.
Right.
You might have different lifestyle goals. You might do something with your super. You may invest elsewhere. You may really enjoy yourself in your later years. Whatever the case is, but if you don't have,
Die with nothing left, like die with no assets, kind of thing. Yeah, whatever the thing is.
whatever you choose, yeah. But in essence, if you don't establish that relationship early on, it's just going to be a lot harder for you. And quite often you can be in a situation where you've worked hard and, you don't want to end up having to I don't want to say lose everything, but you don't want to have to work so hard over the course of your life to
have it clawed back from you.
Yeah, struggling.
Yeah.
Especially in your older years.
And I think there's something interesting about that, which I want to just quickly touch on, is this idea that there's, if you take on debt to do a thing you emotionally want to do, like buy a home, that is also creating financial wealth and options, you put it, it's still a debt. It's still there. It's still on the balance sheet. And part of being responsible with debt is acknowledging that continuing to kick the can down the road and to grow the thing, not to cast stones at any, national country at the moment who might have a lot of debt. I think Australia does too, but we all know who I'm talking about.
Yes.
You still need to be responsible with this thing. And if it's at a household level and a personal level and you're not on top of that, it compounds in other ways. As you said, it creates emotional stress, it reduces options. In fact, it might force outcomes that are suboptimal when you least want them. And so job number one is understand, your household. Job number two, if you take on debt to do a thing, is to put some breathing room between you and the debt. Yeah. And then from there, it's like, now we can talk about options.
No, exactly right.
Yeah.
And I think it's another way to look at it too is because the interest that compounds on your, the first mortgage you take out.
Yep.
If you look at 30 years versus say 15 years, there's going to be a significant difference in the amount of interest you're going to pay.
Right.
So then it comes back to, understanding your budget, how much disposable income you have, what you're going to use that money's for.
Yeah.
Are you going to spend it? Are you going to put it into the mortgage?
Yeah.
Different things, whatever the case is. I think it's a good way to just have a look at, let's say let's say you got married at 27, bought a house at 28.
Yeah.
Maybe take a step back and be like, all right, taking out a mortgage at 28, 30-year mortgage takes me to 58. But what will our life look like if we pay off by the time we're 48 or we're 38?
Right.
From that perspective, you can start to see things a bit more clearly.
Yeah.
And it's like, okay, where do I want my life to go? How much more do we have to sacrifice now in order to get to that stage?
Might be less than you think.
Yeah.
Might be $300 a month. I think I did the maths. It was roughly $300 a month.
Exactly. And that's just because the effect of compounding interest, it builds up.
In both directions.
Yeah, exactly. So, if you get on top of it, you can really start to plan like, all right, this is where I want to be now. Is this achievable? What's the feasibility of it? And you can start to really break it down to actionable items.
Yeah.
Okay, this is how much we can put aside.
Yeah.
This is, we're employed by someone, this is how much we want to be earning.
Yeah.
So it just gives you some harder goals to look at.
Yeah.
Rather than just looking at, the bigger picture, be like, oh, doesn't look attainable, never going to get there.
Yeah.
You sort of got to keep chipping away at it.
Yeah.
Over the course of time, you'll be in a really good position.
Right.
And you have a really good relationship with your debt.
Yeah. All right. So we've talked a bit about kind of a simple scenario. Someone's bought a place and they've paid it off a bit, got a few options. So I'm kind of curious to talk about maybe one or two other examples of, navigating in this relationship with debt you talked about. And I think one of the ones that we've been talking a lot about previously, so I wouldn't mind starting here, is debt consolidation.
Yeah.
Right. And firstly, let's explain what debt consolidation is. But I also want to kind of understand how we arrive at this point. How does someone go from having a mortgage and they're getting on top of their mortgage and suddenly all these other debts pop up? Like, what happened? How did we arrive? And then, like, what do you do from here? So let's talk a bit about that.
Yeah. So in simple terms, debt consolidation is where you have more than one debt and you can utilize the equity in your mortgage in order to consolidate those debts.
Yeah.
In essence, you're looking to, your repayments are too high and you need to either lower your repayments or, lower the interest you're paying on some of those other debts.
Right.
Because, home loan rates are a lot more affordable than, unsecured lending products that are out there.
Sorry, define unsecured. What do you remember?
Just, you can go and apply for, say, a car loan or personal loan.
Anything that's not a home loan, basically.
Essentially, yeah.
Okay.
Yeah. So in essence, that's that's sort of like the simple outlook on it.
Yeah.
However, again, for me it's a personal thing, and you want to understand, like, what are you trying to achieve?
Yeah.
Like, are you at a point where you're going to default?
Right.
You're going to default your payments. You need to reduce that like pretty quickly, or are you looking to just save some money, put some money elsewhere, use that disposable income to again lower your own occupied debt? Like, there's a few different ways you can go about it.
Sure.
But yeah, in essence, it's a good way to review your mortgage, some other debts that you might have.
Yeah.
And just bring it all together and have a really thought through plan.
Yeah.
So that way you can tackle it moving forward.
Got it.
Get ahead.
Got it. And so I guess the thing that and I'm being a bit presumptuous and I'm kind of doing it to be provocative, but if you bought a place, I think you used the example of 28.
Yeah.
And now let's say you're paying it forward, you're 35.
Yeah.
We've got a bit ahead on that debt and the property's gone a bit, so you've got a bit of equity.
Yeah.
But you come back in and say, hey Jesse, I've got these 2 other debts here. Like, is it a sign that the plan's kind of gone off the rails? Like what's typically happening when someone has got that debt? Like where does it come from? Like, what have they done? Have they done something wrong, I guess, is my question? Or is it just this is how life works? Or
no, so firstly, it could be like maybe you've made an impulsive purchase, like
epic stereo system. That was my impulsive purchase.
So a lot of people like a nice brand new car.
Right.
For instance, they may have taken a car loan out, racked up some credit card debt over the course of time.
Yeah.
Maybe in between that 5-7 year period, there may have been a life event. Yeah, and you may have a bit of credit card debt. You may have taken it personally. You may not have just thought things through exactly. Or on the flip side, you just haven't reviewed your debts.
Right.
Like, you've just you just let it. You've gone in auto mode and just let it.
Yeah.
Well, you haven't really thought about, okay, what am I going to do now?
Yeah.
Then be in a certain position in the next 5 years.
Right.
So
any number of reasons why you might.
Yeah.
I mean, in some respects, this stuff can be kind of dry. Like, we're debt nerds, right? So we're different. In that respect, like, I find this stuff interesting and not exciting. That's probably the wrong word, but I want to do it well, and I'm looking at it very frequently.
Exactly.
It's part of like the dialogue that you're having with a client is, I get it, this stuff's not anywhere near as exciting as buying a new car or booking a holiday, but those things are impacting your relationship with debt. So, let's have a conversation.
Well, not only impacting your relationship with debt, but just what's your goals?
Right.
We
had a plan.
Yeah.
What are you doing?
Exactly.
Is there any tough love that comes out of this when you're having conversations with clients? Like,
look,
softly, Brad.
I think you got to give it straight. I don't want to talk that down with anyone, but you do have to give it straight,
right? In
terms of, so people understand, like, all right, this is where we're at.
Yeah,
this is what's going to happen if especially if they're in a high risk situation where they're close to maybe defaulting on their repayments.
Yeah,
you never want to get into that situation. So you've got to give it straight, so that way they can start to make informed decisions.
Yeah. And
with that generally comes, here's a plan, here's a solution.
Yeah, pathway forward.
And then that's where you compare, the before and after.
Yeah.
Like, if you follow this plan, then
right.
Say consolidate some debts as an example. This is where your repayments will be, or this is how soon you can pay off that extra debt.
Yeah.
That you've consolidated, be back at square one, or back ahead again.
Yeah, sure.
Whichever way you want to look at it.
Yeah.
It's just about sitting down and just, be vulnerable.
Right.
To put yourself in a better position.
Yeah.
Moving forward.
Interesting.
Yeah.
I mean, we don't talk about
that
idea often enough. A friend of mine is like he lives and breathes this idea that so much can be gained through a bit of vulnerability.
Oh, I agree.
And it's like a mortgage broker in a lot of cases is, especially if they've got kind of the empathy, which you obviously do, can be kind of this, safe sounding board where there's no silly questions, there's no judgment. Just come in and wherever you're at, we'll talk about it.
Yeah.
And let's navigate it together and let's get you back on track with what it is. Or if your goals change, let's adjust the plan. But there's no loss in coming in and having a dialogue to try to get yourself better ahead. And your future financial self, emotional self, physical self will thank you for it.
Yeah.
So just do it. Even if there's no action to be taken today, like when you think about like what a healthy relationship with debt looks like from a client perspective, in also in concert with yourself, like what's typically the frequency of the dialogue? Is it you talking to someone every 12 months, or how often would you suggest makes sense for them?
No, I'll talk to them much more regularly than 12 months.
Yeah, okay.
Yeah. No, generally, at the very least, I want to touch base with someone within 6 months.
Got it.
Yeah, or sooner.
Just to check the plan's still on track and not throwing the plan or things haven't changed.
Quite often people do make, changes and want to discuss something else.
Right.
Well, they just want to have a chat. Or an excuse for a coffee. But,
no excuse required. Got it.
Yeah. But things do change. And in the mortgage space too,
right,
we've got to keep on top of the market and where it's trending with what the banks are offering, rates, etc.
Yeah.
So I think when things shift, you can't just go quiet. You do have to.
Can't set and forget.
Yeah, you do have to. Yeah, as a mortgage broker, you do have to pick up the phone and check in.
Right.
Perfect example of when we went on that run from where rates went from 2% to 6%. You can't wait. You can't sit back 12 months and think, oh, how are you going?
Yeah.
It's like, oh, I'm feeling it.
Yeah.
Just had 12 interest rate increases in a row.
And so, like, for someone who's listening who has a mortgage and isn't a mortgage broker, I guess is the point, they should be hearing from their broker quite frequently and should be thinking about it in terms of the role of the broker is not limited to help me get a loan when I need a loan.
Yeah.
It's I have a relationship with debt and I'm not having a conversation really with my accountant about that. I might be having it with a wealth advisor. They tend to be more focused on where you're investing rather than debt necessarily. And the bank's certainly not coming to you saying, there's 10 ways you can pay it down faster. So your mortgage broker as a mechanism for talking through and ensuring alignment between, the goals that you have and the structure that you have and what you're actually doing, are kind of, you should elevate your relationship with your broker, I guess, is what you're saying in some respects. Not to get into kind of financial advice or even specifically financial coaching necessarily, but at least here's the numbers,
Here's the numbers and here's someone that can listen and start to point you in the right direction.
Right.
And someone that can actually advise you on your mortgage.
Yeah.
So I think a really important point to remember this is the whole banker versus broker.
Right.
I guess a relationship that we're sort of going to dive into a bit. The banks have handled some of their hardship, their hardship sort of processes and policies quite poorly.
Right.
It's been thrown out there in the media.
Yeah.
You call up your bank, there's been a life event or something that's, impacted your ability to repay your debt, whatever the situation is. Sometimes it's handled well, but there are certainly a lot of circumstances where it's not. And people are left, high and dry.
Right.
And who's accountable? It's like there's tens of thousands of staff at whichever bank you're calling up, right? Yeah. It's someone, that's just taking a call. They don't really know you. They don't know your situation.
Yeah. They haven't been on the journey with you.
They haven't, no. So that's specifically where you can get, you feel the heat, you feel the stress build up, and you want to get on top of it because you don't want that to start impacting your relationships. And, your health and well-being and things like that.
Sure.
Forget about the numbers for a second, just that aspect of your life. So, that's where you can talk to a broker and just be like, hey, what do I need to do?
Yeah.
And they can talk through, these are the steps that you can do. This is what we can look at.
Yeah.
It's about having that conversation so the right action can be taken. And I'd also add to that, you want to identify these things earlier as well. Right. If there may be, a particular problem, something that's come up, because when it happens later on, you've got bad credit, you're behind.
Yeah.
The issue just compounds. And
limits your options, right?
Limits your options, and you'll see why the banks aren't so friendly either. So, but but it's true. They do become very transactional at that point.
Right.
time. It's just the nature of.
I just paid you for 8 years straight, and now you're throwing me under the bus at a year and 1 month.
Yeah, it's the nature of the beast. So that's where a mortgage broker can play that role. And go back to what you were talking about before, on vulnerability. Yeah, you don't want to be vulnerable to everyone, but if you can choose someone that you trust,
right,
then it can really help you start to make informed decisions.
We've talked about debt consolidation. One of the other ones that we spoke about before we hit the record button, which I think we should dive into, is these other kind of debt scenarios. And I think the example you were giving was around self-employed and business. So let's talk a bit about that relationship with debt, because that's different. That's altogether different.
It is different, yeah. So that's where if I can break it down simply first,
sure,
and then we'll go into some of I guess the broader issues that business owners can face. So let's say you're a sole director shareholder of your business, a lot of moving parts. In your business, you're worried about cash flow and different things. You got to make sure that you pay your staff, pay yourself a wage.
Right.
That wage then goes towards paying your mortgage. So following that trail of money, so to speak. But with businesses, quite often, you may have ATO debt. At certain points, you may have cash flow issues.
Right.
How cash flow sensitive is your business? You may have taken out, business loans for a car under your business, or
a deduction at the end of the financial year.
Yeah,
that's a common one, isn't it?
Yeah, or you may have wanted to take out funds and use them for some other business purpose, whatever it is.
Sure.
But if you haven't had a thorough understanding of your numbers inside your business,
right,
or you hit a bad cyclical period, where there's a bit of a downturn in revenue, whatever the case is, like, it can, you'd be in a situation where you've got a lot of pressure put on you, and then you've got to pay everyone else, but you still got to find a way to pay yourself to then pay your mortgage.
Sure.
So this is where it's a bit more of a complex situation, where you're not just thinking about one day, you're not thinking about just, I might have a credit card I need to review. I've got my mortgage, I've got maybe look at my balance sheet, I've got maybe up to 5-6 different liabilities.
From the business perspective.
Yeah. And just the whole relationship of cash flow, coming through the business, and just paying everyone, paying yourself, can be quite challenging.
Yeah.
And if you're not on top of it, it can be a situation where it puts a huge stress on you and the business.
Yep.
To look after the business, keep the business operating, but then at the same time, your family.
Yeah.
You've got your spouse and kids at home, and you're stressing about that too. Like, how can I pay myself to keep on top of my mortgage? So, there's a lot of moving parts, and that's where I do encourage people, if you're in that type of situation, and I know for a fact, just through my experiences, there are a lot of business owners out there that are struggling with those type of obstacles, and those.
And you wouldn't think to talk to your broker about that, or obviously you'd have some dialogue with your accountant, but it's part of where you're going here, and tell me if I'm wrong, but you have, in some respects, two balance sheets. You have the business balance sheet and the incomings and outgoings for that, and you have the home balance sheet. Spouse might have some income as well. There's a debt sitting there. There's cash flows relating to that, and these things are separable in a way, but they're also interrelated, and they can be leveraged.
Yeah, one relies on the other.
Right, but also can one go back the other way? If you've got equity in the home, would you? In theory, you could use that to improve the financial or the relationship with debt you might have on the business side, or is that typically not done?
So if it's a situation where you've got say multiple directors, different third parties,
right,
different households, you typically don't go down that avenue.
Right.
Then again, it depends what the context of the situation is.
Right.
Before you start mixing,
right,
your home.
Church and state.
Yeah. But if it's, say, you and your spouse or say you're just yourself 100% director shareholder, you can have a look at the whole holistic picture, and see what debts in the business do we need to clear or prioritize in order to improve our cash flow. So we can take the strain off the business itself, and also strain off me paying myself a wage. In order to ensure that I keep on top of things. And I'm not going to lose track. I'm not going to fall into arrears, default. That's
on the company or on the personal side, or both.
Because as soon as that happens, it's it's permanent. It's on your file, and that can also impact later on down the track if you're looking to invest heavily. And do some other things to build wealth.
Do anything really. I had a situation when I was younger where I was a shareholder and a director of a company. In fact, I don't think I was a director at that point, or I was no longer a director at that point. Either way, through legacy, we had a business credit card that was in my name, and the company paid it off every month. It was used for company purposes. There was never any question that it was for the company, but it had a human attached to it, and that human was me. And I ultimately left the company on totally fine terms, and moved overseas, and the credit card remained and continued to get used for business purposes, which was fine until it wasn't. And then I came back with an intention to buy a home when I moved back from America. Just when I started UNO, actually. And one of the first things they said was, we've got this $7,000 outstanding debt for credit card that hasn't been paid. I'm like, and it was incredibly challenging to navigate and very stressful as well, actually. Just coming back a step on, you talked before about relationships, and you sort of said, look, if you've got a pretty standard, you earn a salary and you have a property and you pay some tax and then that's the end of it, you might lodge your tax yourself. If you have an accountant, you can think a bit more strategically about some of that stuff. I mean, if you encountered someone who was self-employed, maybe they owned a business with some other partners, or they owned it entirely themselves, and they had, cash flows and debts in that business as well, and they didn't have someone who was strategic as an accountant, would one of the things you were saying to them is, you got to get yourself an accountant, or B, a better accountant, because this is so, the tax aspect of this is just as critical as the debt. Like how much do you lean into that?
I mean, I'm not gonna order someone around.
Sure.
But I definitely tell them.
Strongly recommend.
I'm like, think about where you're at.
Okay.
And the severity of the situation.
Sure.
Particularly if, there's different, consequences for different types of debt. If you're looking at the order of things, I guess, on the balance sheet, you really don't want to be in trouble with the ATO.
Right.
That's probably one of the biggest ones. And then it's about really understanding the terms and agreements on other debts that may appear on your balance sheet. So having an accountant that's more strategic. Again, we've covered on it before. You just pick up the phone, talk to them. It's not like I'm charging you. I'm charging you for every 5 minutes you spend on my time, sort of thing.
6 minutes tapping the clock like the lawyers do.
Someone you can have that open, honest relationship with. If you're open, honest, vulnerable, we'll say you're an accountant or a broker or someone in that space that you trust.
Sure.
They're gonna want to step forward and help you and put a plan in place so that way you can either avoid serious consequences or get out of really dicey situations.
It's only going to get dicier.
Understood.
Okay, cool. So we kind of talked through 3 buckets of, not life stages per se, but types of scenarios, and there's going to be other ones, right? We haven't covered off today using equity to buy a place, or what happens if you have a separation, or large financial shock like a big medical bill, or someone not able to work for a period of time, or even coming into a lot of money. These are things that come into change the plan, and the relationship with debt changes. But the 3 we did talk about was someone looking to buy and buying their first place and thinking strategically about that. Getting to a point where the plan might have gone off the rails a bit, or something might have happened, they got a bunch of debts and they're thinking about debt consolidation. And then the third part there being someone who's self-employed or has a business or a part owner of a business, and now they're thinking about two balance sheets and two bunches of debt, and two plans, and they're kind of interrelated, and one person getting all the stress. So if we're going to kind of wrap that all up and round that out, what are the key takeaways here, and what are the things to just recap on?
Yeah, look, I would say is first and foremost, if you're just blind to it and you don't know your numbers, your ins and outs,
right,
I think step back and take a thorough look at it.
Yep.
And with that to understand, how much disposable income do you really have?
Yep.
If something happens, is there enough surplus there to cover?
Mm-hmm.
Just get a really good understanding around that. Adding to that, say secondly is, what's your longer term goals?
Mm-hmm.
So once you start to work out and envision where you want to be, in your wealth journey, or even just life's journey of where you see yourself, say when the kids are grown up, as an example.
Yeah.
You're able to then put in some more actionable, items, action steps to then get there.
Yeah.
And using debt as the key tool to not live a life of stress, but to get ahead.
Yeah. Find that balance.
Yeah, precisely.
It's good, but don't, like anything, Christmas cake's good too, don't have 17 slices.
Yeah, exactly.
You want enough, but not too much.
Yeah. But yeah, you use it to your advantage, put in place some really good habits.
Sure.
Because you can't control what you can't control, but one thing you can really take ownership over is your mortgage, and doing what you can to put extra monies in, savings aside, and offset, whatever the case is.
Yeah.
Get ahead, so that way you've got options.
Sure.
Because your goals are going to potentially change as well.
Yeah.
If you don't have options,
Yeah.
you've got nowhere to go.
Got it. Yeah, and you kind of narrowed in on the plan. Okay, cool. So, and then probably final closing point?
Look, I think just, in terms of, final point, I would say is just don't be afraid to pick up the phone.
Yeah.
Inquire to have a chat.
Yeah. Doesn't have to be about a home loan right now.
No, it doesn't. It doesn't, I'm not here being like, you got to sign
your
life away right now or anything like that.
Yeah.
But, just establish, a relationship with someone that you trust.
Yeah.
Or someone that you can have an open conversation with, and someone who's going to listen to, your goals, and that way, you can come out of these conversations with, some more clear objectives.
Yeah.
A better understanding on your relationship with Dad.
Yeah.
And, a plan that you can put in place.
Yeah.
In order to get there, and a bit of a timeline.
Yeah, and I want to narrow in on one word that you said then, which I think might tie this back to right where we started as well, because I think you mentioned this before we jumped on, which is about having a plan, but it's got to be your plan.
It does. 100%.
Not some plan that you gleaned off a YouTube short that went for 45 seconds. That's not in your context, doesn't understand your emotional, state or your situation or your personal desires or anything. It's got to be your plan.
It does. It does. 100%. Don't let anyone influence you, force you to make any decisions.
Yeah.
Stick to what you want.
Yeah.
Because we all want something different. But use that in a healthy, positive way in order to, get there. Reach out, speak to the right people if, you're unsure of where to go.
Yeah, wonderful.
Yeah.
All right, Jesse, wonderful, mate. Well, thank you. Really fun chatting to you.
Yeah.
Hopefully everyone got a bunch out of that, and if someone feels like they want to be vulnerable, they can obviously pick up the phone and have a chat to you.
Yeah, perfect. I'm here for it.
Thanks for listening. If you have a topic you'd like us to cover, just email us at hello@uno.com.au. If you'd like your current home loan or next home loan taken care of, just reach out to your UNO broker or email us. That email again is hello@uno.com.au. If you enjoyed this podcast, please leave us a review.